welcome to Shock Factor video number 5. And in this video, more shocking facts shall be unveiled. And again, I just want to make a quick comment that please do not get too concerned with all these videos that you have been watching so far. Yes, I know it's shocking. It's also riveting in a sense, but don't get too concerned because, again, as I said before, there is always a light at the end of the tunnel, okay? Right? Hint, 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 hint. Okay. I do not want to detain you any longer. Without much ado, besides the slight comment which I want to make, I just want to make one more statement, if I may, if you allow me. And it's just a slight. I have a slight concern because I've been doing this for over 25 years, or around 25 years, and I've seen a lot of traders come, more traders actually go than come, and their lifespan as a trader, their shelf life normally is. The reason why I'm developing this set of videos, the Shock Factor series, is because I want to address this problem once and for all. Let's just address these issues and how it invisibly impacts our system, our trading approach, especially if you're using a technical approach. That means using technical analysis. Doesn't matter what kind of technical analysis, it doesn't really matter. As I've said before, it doesn't really matter because all the 15 issues that you're going to see, between 11 to 15 issues, based on my entire Shock Factor series, depending, I'm not sure whether I'm going to do up to 11 or all the way up to 15. If I have the energy, I'll do all 15. Okay, but you see, I'm quite frustrated over the last 2 decades because I see a lot of traders fail. A lot of traders fail. A lot. Very few actually succeed. I mean, I'm talking about speculative trading, speculative, not investing. That's a different story altogether. If you're investing, you buy and you hold and you're looking for dividends, and that's a different thing altogether, okay? I'm talking about speculative, using technical analysis to engage in speculative trading. That's what I'm talking about. Whether you're a short-term scalper, really short-term, or you're more of a position trader, whatever. Or you might sometimes transition into a long-term position holder as well, similar to an investor. It depends, So it depends on the situation and whether you can keep on rolling your stock to lock in profits and that kind of stuff. It depends on many things. But generally speaking, if you're going to use technical analysis in the markets, these 15 videos will be critical to you. I'm not joking. I'm very, very concerned. I've seen so many traders fail. See, the worst part about not succeeding in trading as a speculative trader, the worst part, do you know what's the worst part of this entire campaign, this entire exercise, is that they don't know what went wrong. They do not realize, they cannot understand, they cannot comprehend what actually went wrong. From the first, in this first 5 Shock Factor videos, you can already see why the majority of traders cannot understand why things went wrong, because the answers does not lie in the realm of technical analysis. For example, Shock Factor video 1, to do with trade size, the different trade sizing approach. There's 2. I only illustrated 2. There's actually many more. I've just done 2 just for the sake of simplicity. Okay, I don't want to drag things down into such complexity that you lose the actual message I'm trying to convey to you. But I gave you 2 basic technical trade sizing approaches. Some people call it lot sizing. But anyway, as you can see from video 1, you cannot solve that using technical analysis. If you go back to video 1, you see all the entries, the stop losses, and the long positions that we enter. That could come from any technical approach. That could be a moving average. It could be, just like in video 1, a breakout strategy. It could be anything. It could be Elliott waves. You could be trading trend lines, moving averages, double exponential moving average, whatever it is. Okay, Ichimoku Kinko Hill, Heiken Ashi. You could be using bars, candlesticks, line charts, All that doesn't matter. You could be using different time frames. It also doesn't matter. It cannot save you. By modifying those things, it cannot save you. Because the average trader, they don't understand how to resolve. In fact, they don't even know the problem exists. That's the worst part. As I said, the worst thing about losing all your money in trading is that you do not know why. And then you follow other people's advice. Top up, put in more money. The more money you lose, the faster you will learn. I mean, honestly, I don't want to use my French here. Okay, I avoid using French, but honestly, that's the worst advice you can ever follow. Please don't do that. Because each time you top up, each time you lose, you have no idea why. Okay? I can almost guarantee you that you have no idea why. Not you, but the majority of traders, even professional fund managers. Unless you can solve all 15 shock factor issues. If you can solve all 15, yeah, go ahead. Yeah. I'll be much more confident that you will survive longer. Well, at least your survivability factor will be much greater, significantly higher. You elevate yourself to the next level. Okay? But then there are other things that I want to talk about outside the shock factor series. That would be another series, which is, in a way, it is also shocking, but this particular shock factor series is especially scary, if you like, putting it in a simple way, is because you cannot solve any of these issues using technical analysis. You cannot. That is the scary part. You see? If you could, then you could backtest using a different moving average period, for example. Okay, a different look back period, for example, and that supposedly that now seems to solve your issue. No, it does not. It might resolve it in the immediate future. But once the market once the market changes its behavior, because a market is like a virus, it keeps changing its form, its structure, all the time, presenting you multiple random scenarios. Unless your system is perfectly robust, you cannot keep up with the market. It's just like trying to solve the cure for the common cold. So far as I know today, they can't do it. You can buy over-the-counter medication to relieve the symptoms, but you still cannot cure the common cold. Why? Why is that? Just like the market. It's like a virus that keeps changing structure, keep changing, modifying, amending, evolving, devolving, all kinds of stuff going on, adapting. So unless your methodology can do all that as well, evolving, devolving, adapting, unless it can, the word we use in trading we refer to that as being very the degree of robustness. How robust is your system? Not easy to do. Really hard job to get that done. And even if you can, that doesn't guarantee success. You know why? Let me tell you why. Because you still cannot solve any of these. The trader still, after watching all these 15 shock factor video issues, and he or she still is grappling, in the dark, trying to figure out how to solve even one of the issues, then my advice is don't trade. You can go trade all the demos you want, all the demo accounts. Don't put any real money. Don't risk your hard-earned capital, your life savings. Don't risk your children's inheritance by jumping into something with 2 feet, jumping into a pond with 2 feet without knowing how to get out, without knowing how to swim and float above these 15 issues, overcome, surpass, transcend above these 15. If you can't do that, I recommend you better take a step back, because I'm a really conservative and very cautious, very circumspect as a trader. Okay, we don't just jump in just because we are focusing on the best case scenario. That is the worst thing you can ever do. Jump into trading, put in tons of money, tons of capital, and have a best case scenario mindset. Best case scenario. Might as well just give it all to charity. Trust me, it's easier that way. You don't have to go through the pain of sitting in front of your monitor. Okay, just trust me. And again, although psychology, I just want to say something. Psychology, trading psychology is wonderful. Like Mark Doug, if you have ever read the book by Mark Douglas, it's a fantastic. I mean, I really love that book on trading psychology. It's fantastic. He wrote 2 or 3 books, really good. Of course, he has passed away many years ago, but that was one of the best books that I have ever read on psychology. But again, the reason I mention is that there's nothing wrong with psychology. Read as much as you want. Go read as many books as you like. Attend as many courses. But let me get back to the point. There's no amount of psychology, and I say this in a very good way. Okay, with a pure heart. There's no amount of psychology can solve. No matter how good you are, even you have a PhD in psychology, there's no way you can solve any of these 15 problems using just pure psychology. It's not possible. So although psychology is useful, it get you into the right mindset, reduce your stress, get you very focused, get you to follow your trading plan, all that is fantastic. Diminish any fear that you might be harboring from your past experiences. Yes, psychology is wonderful in disarming all your fears and all that. It's really a wonderful science, a really good thing to really try to adopt in your life. But again, on the flip side, it cannot solve any of these 15 issues, because these 15 issues, even technical analysis, if you're going to use technical analysis to solve these 15 issues, you can't do it. The answer lies outside the realm of technical analysis. The answer lies outside the realm of psychology. The answer lies outside the realm of NLP. So although all these things that I mentioned, all these sciences that I mentioned, and approaches and all that, they are wonderful things to adopt. Yes, they're all great stuff. But what I'm trying to say is very specific. It cannot solve these problems. For example, solve the equation for a gravitational attraction between 2 celestial bodies in a galaxy 16 light years away. Tell me, what kind of psychology can solve that? What kind of NLP can solve that? Nah, cannot. But are they useful? Yes, they are. But can they solve this particular problem? These 15 issues? No, they cannot. Not possible. That's why I'm just trying to bring reality, okay, to your understanding. I just want to introduce a bit of reality. Let's call it a reality check. Okay? So basically what I'm saying is that don't risk any capital in the market until you understand what can affect you. So again, let me give you the punchline. The worst thing that can happen in the market is not a trader losing all his money in a trading account. It's not. That's the second worst thing. The worst thing is that losing all the money without knowing why. That is the worst thing. That means you have no way back. You have no way back. It's a one-way ticket. And all sense of hope goes out the window. Okay? And that is what I'm trying to. I just want to make it very clear. What is it you need to resolve these issues, okay? And all these 15 issues that I'm going to present to you so far, up to the point of this video, is only 5 issues. There's another probably 10 more to go. These are things that are not significantly obvious to most traders, even professional traders. Yeah, it's not. Yeah, I've talked to many professional fund managers. I gave them issue 1, 2, 3, shock factor 1, 2, 3. Until today, they have not given me any solution. Yeah. And these are people who have traded 30, 40 years, institutional funds, and they too cannot solve it. So what hope lies for all the rest of the retail traders out there? It's tough. It's tough. And again, the worst part is also another shocking factor on top of the shocking factors that I'm already talking about, is that sometimes your technical trading system or whatever system you're using, unless it's arbitrage, some kind of quantitative stuff, long-term investment in stock, all those are different. Okay, it doesn't affect those that much, but it affects speculative trading using technical analysis. That is the group that this will affect all of you the most. Okay. I tell you what, let's press on with the rest of this video. Okay, I just want to share a little bit of my let's call it my 2 cents worth of advice, my basic opinion with respect to how we should approach the market if we don't know how to solve the major issues that I'm presenting to you. Okay? All right? So some traders, they find that they can't make money. Okay, so what they do is, assuming they're using a moving average approach. So now they're going to do a back test. They're going to back test and look for the best case scenario where a certain look back period makes it's the most profitable over the last year, 2 years, or so on. And now they're going to adopt that particular look back period going forward, trying, or at least in the hope of trying to make some money, because it worked fantastically over the last 2 years. It should, using simple logic, it should continue to work profitably, at least in the near future. But have you noticed every time a trader does that, the moment they get into the market, immediately they start losing money, and then they're scratching their head. Okay, I'm going to cover that as well in one of the 15, why that happens. Okay. So a lot of stuff. So backtesting doesn't help you. Yes, it's useful. It can give you some insight. It can give you some information. So what may or may not be the right kind of values that you chose for your parameters. In that sense, it's okay. But you got to backtest the right way, not the way that most traders backtest. They only backtest to see what is the most profitable outcome. There is a lot of flaw in that. Okay, if you do it that way, it is basically doomed. Inevitably, you will lose your money if you do it that way. You backtest to see what settings, what parameter values gives you the greatest profit over a certain period, and you adopt that going forward, you're in big trouble. Let me just tell you that. In fact, it's the opposite. I know it's shocking, but this is the opposite. If you adopt the worst possible system that loses the most money, that is the system that you should go after, but not in that form. Because if that happens, all you need to do is a slight adjustment and you turn it into a winning system. You know why? Because it is consistency we are looking for. Ultimate consistency. And if it's consistently losing, very, very consistently losing in a horrendous manner, that is the system that I go after, not the winning system. Okay, but I know you are confused as to why I'm saying that. But we do have to modify, do some adjustments to the horrendously consistently losing system to turn it into the most powerful winning system ever. Okay, so a lot of things is counterintuitive. It's counterintuitive, yeah. But you got to know how to do it. That's the question. You may understand it, but how do you actually do it? How do you execute? How do you do the amendments and the modifications to get there? Okay, so that's the last thing I want to mention or comment on. Let's press on to the next slide. Let's go. Okay, so this is officially shock factor video number 5. This is the 5th hurdle. Again, this represents the 5th hurdle in applying technical analysis in the markets or to the markets. Okay, let's press on. Okay, sit down, put on your seat belts, and put on your crash helmets as well, and get ready for a rough ride. Let's go. Okay, before I start, can I just have a sip of water? Because this is all done in one take, so I need to have a sip of water before I carry on. Okay, just read the first slide first before I start. Just have a look at it. This at the illustrations in front of you. There are three setups, all identical except for one component. Okay, give me a second. Hang on. Okay, in front of you, you have 3 setups. These setups are all perfectly. And when I say the word perfectly, I actually mean perfectly identical in every way. Their winning percentage are all identical. Let's assume the winning percentage is 52%, and they managed to maintain this 52% week in, week out over the last 10 years. So let's assume that you have a trading system or trading setup that's consistently winning over the longest possible time. For example, over the last 10 years. Week on week is making money, and for some reason that we don't understand, it is a miracle that you are able to maintain your winning percentage. Let's assume it's 52%, and it never changes week after week after week after week over a period of 10 years. That's, of course, it's unrealistic, but I want to assume the extreme, because when we use extreme examples, it is easier to there is a higher level of clarity. When you push something to the extreme, it's easier to recognize the flaws, the pros, the benefits, and the advantages, and so on. Okay, so let's carry on. Hang on a second. Okay, so let's look at setup number 1. Okay, now in this setup, we have a reward to risk ratio of 1:1. Okay, if you take the reward divide by risk, is 1:1. 0.5 divided by 0.5 is 1:1. Okay, so the profit size and the stop size. The profit size is the distance to the take profit. The stop size is the distance to the stop loss. So your stop size and profit size are identical distances away from the entry. Okay. Same here for setup 2 and setup 3. All are identical. They all have the same winning percentage at 52%. Okay. And there's no other parameter changes. Nothing else changes. We keep everything the same. Identical throughout the 3 setups. No differences at all. None. Not even an iota of difference. 0. Except for one parameter. The allocation of risk. That's the only difference between the 3 setups. Okay? That is the only difference. So here we risk 0.5% in order to make 0.5. Hopefully we can take advantage of certain market conditions, and hopefully, potentially, we're hoping to make 0.5 by risking 0.5 to make 0.5. In the second setup, we're risking just a little bit more, but I'll get to that in a short while. Let's come back to this setup first. So everything across the 3 setups are identical except the amount that you risk per trade. The amount that you risk per trade. The amount that you risk per trade. That's the only difference. The winning percentage, all of them are 52%. Let's just assume for some reason it's 52%. If they hit 52%, they are profitable. It's a winning system. And let's assume that never falls below 52. It is always week after week, week on week, week after week, over the last 10 years, it's always been 52. I mean, I know it's a stretch. It's almost impossible to see that occur in reality. But let's just assume, let's push things to the extreme, just to make things, just for the convenience, of trying to explain what's going on here. Okay, it's just for my convenience. Okay, it makes my job easier. But let's assume in this scenario we are making money. Our average profit and loss is positive over the last 10 years, week on week, positive, positive, positive. Okay, winning percentage never changes. Miraculously, for some reason, it's constant at 52%. Reward to risk ratio setup never changes. It's always a 1:1. Never changes. Not even in the slightest. It's always perfectly 1:1. Okay, let's just assume the extreme case. The win-loss distribution never changes. It's always the same. Every week, at the end of every week, it doesn't impact the system. There's no random wins and losses distributed all over the place. As like in the earlier examples which I demonstrated to you. Let's assume that this doesn't affect. Oh, sorry, there's a 5. I don't know why that is there. Let me just get rid of that. Okay, problem solved. Let me just save that. Okie dokie. Right. So let's assume this is a profitable system. If over 10 years you're making money, for over a period of 10 years, week after week you're making money, that has to be classified or categorized as a winning system. If that is not classified as a winning system, I don't know what a winning system is. I mean, it's fair to say this is a winning system. So, and all this is by virtue of whatever. It doesn't matter what technical approach you're using, moving average trend lines, whatever, it doesn't matter. This applies across all technical approaches. There's no technical approach that's free from this problem. None. Okay? Especially if you're using pure technical analysis, not statistical or anything like that. That's different. And in this case, we assume randomness Remember in the first video shock factor video 2, 3, and 4, they talk about a bit about randomness and how it affects you. Assume that these three setups are not affected by randomness, which is ridiculous. But let's just assume the extreme. No, they're not affected. So the win-loss doesn't randomly jump all over the place. Okay, it's not. It is not. Sorry, hang on. It is not subject to randomness or anything. It's perfectly deterministic. So let's assume this is perfectly, statistically speaking, deterministic, not probabilistic. No probability involved. I know it's not really it's unrealistic to make that assumption, but I just want to make it, just to remove all other factors from our equation, everything else being equal. Okay, if you understand what I'm saying. Okay, let's carry on. So this we know this is a winning system. Okay, let's assume it's winning. Now, what about this? If this is a winning system and there's no parameter changes, if I increase my capital at risk, I reach just a little bit more capital, let's say 0.6%, then I should be making money, more money than what I did here. This setup should be making more money because it is a winning system. Nothing has changed. The winning percentage is still the same. Reward to risk ratio is still the same. Everything else has not, there's no amendments, no changes in any other parameters or the value in any other parameters. So guess what? Logically speaking, am I right? Logically speaking, any sane, normal thinking trader person will assume that if I risk just a little bit more, I will make even more. Here's positive. Here's really, really much more positive. You earn much more in this setup as compared to this. So far, everyone agree? We all agree on this, right? Even I agree on this so far. Okay, but because it's logical, it makes sense. It's totally intuitive as well. It's visceral. We can feel it physically as well, emotionally, mentally, intellectually, whatever it is. We know this makes sense because nothing has changed. So if you risk a little bit more, you will make a little bit more as well. Okay, so far, everything looks hunky-dory. Okay. Now, let's assume that after a certain length of period, you'll be making money using this setup by just increasing your risk by just 0.1%, make it 0.5, let's transition to 0.6, and you're making more money. That should be the case. Yes, I fully agree. That is what we expect, okay, to see. Our average profit and loss, or what I call expectancy, should be increasing. Our equity curve and balance curve at various times should be heading to the upside, pointing to upside, rising. That's a good sign. Okay, that's a clear indication that everything is going well. And then after a certain period, we decide that, okay, since it's a winning system, it has always been a winning system, week on week, week after week. Let's just increase this by just another 0.1%. Let's transition from 0.6 to 0.7. And guess what? Using the same logic, using the same understanding, okay, the same level of consciousness or intellectual consciousness or understanding, everything makes sense. So therefore, if this increased our profitability, okay, over the long term, or over a certain period, by just increasing how much we risk. So if you risk more, we make more as well, okay? The more you risk, the more we make. It makes sense. So far, everything is great. So why not let's do it one more time? Let's increase it. But let's test this for a while. And it seems to be profitable, much more than the first setup. Okay, let's increase it. Okay, we're not talking about tremendous amount, just a little bit. Okay, and what is that? Okay, so this scenario can happen. Guess what? This can happen. Yes, this is where it gets shocking. By just increasing a little bit, and has anything changed? No. Win percentage, still 52. Reward to risk ratio, still 1:1. Every other parameter is identical. So this This move here, which resulted in much more profit in the long run, did not occur here. That did not happen. In fact, it went in the opposite direction. You started losing equity. Your equity curve starts to point downwards. The more you trade, the worse it gets. And if you continue trading, you'll blow up you obliterate your entire account. It will go to zero. This is mathematically speaking. There's no way around it. It will happen. I can guarantee you. But why did this happen? What changed from setup 1 to setup 2? It makes sense, and we did see the results. So what changed? What's the difference here? Although we reached just a little bit more, technically we should see the same progression of increasing average profit and loss, not going in the opposite direction and start experiencing losses in your account equity. This doesn't make sense. I mean, what's going on? How many traders will know this? How many traders will understand what's actually happening? Very few. I'm sure that there are some that can understand this. But if you've never seen this before, isn't it shocking? I mean, let's be truthful. It is shocking. Just a slightly, you should see the same performance being accentuated, elevated, enhanced by increasing your risk to earn more. Your reward or your profit is also increased if you exit. If you have a successful exit or profitable exit, I mean, you make more as well. You risk more, but you make more. Same here. You risk more, but you make more as compared to this. So we should see the same thing recurring, the same recurrence of greater expectancy as we go forward. And if you go to 0.8, you should earn even more. 0.9, even more. Because miraculously, as I said, we make the assumption that it's a winning system. It's a winning system for this one. The first set is a winning. So by increasing, we should see higher profits, higher gains, but not lower gains. Totally doesn't make sense. Am I right? So what went wrong? Where did we take the wrong turn? What happened? Why is this the case? Why? Why is this the case? Why is this happening? That is why it's shocking. So now I'm going to give you proof. Okay, I'm not just going to talk in a qualitative manner. I'm going to give you quantitative proof using an Excel spreadsheet which I created many years ago. I'm going to use that. I'm going to show you proof of this. You see, so that's why a lot of traders, when they lose, they don't know why. They have a winning system, they be profitable over 5-10 years, and they increase the risk a little bit. They make even more money. They increase just a little bit more. They're not gunslingers or any kind of psychotic trader. They are rational, normal human beings. Just a tiny bit, just to be very careful, and then now they start losing money. But nothing has changed. They still win. Technically, it's still a winning system. So what this tells you is that if you think in reverse, okay, let's think in progressively first. In the first place, I'll go to the reverse engineering in a short while. So the thing is this: you could have a winning system here, and here, an even more winning system. This is a much more profitable than this, because you have increased the risk and you earn more as well if you win. So this is a winning system. By just changing the allocation of risk, you just change the risk. You have turned a perfectly winning system into a losing system. That's all. But has anything else changed? No. Did the winning percentage fall? Were you having more losing trades? No. Exactly the same. Exactly the same. So you have successfully turned a winning system into a losing system. And that's good news. You know why? Because many of you might have a losing system, but maybe this is the issue that you're having. By changing the allocation of risk, miraculously, you can, you might be surprised. You may be able to change a losing system into a winning system by not doing anything at all, except changing the allocation of risk. How much risk you put in. into the setup, or how much you should allocate to the setup. Can you see that? So maybe you do have a winning system without you knowing it. It's just that shock issue factor number 5, which is this is affecting you. So without you knowing it, you're actually in possession of a winning system. But because of the wrong allocation of risk, you have successfully converted it or changed it into a losing system. Isn't that a sad scenario? You have something that works, and yet by just applying it just a little bit differently in one of the value of the parameters, is now a losing system. Okay, so this is the thing that I wanted to convey to you. This is shock factor issue number 5. I mean, the first 4 is bad enough, but this is shocking. Not many traders understand it. So now let me go to the next slide here, just to clarify, just visually and optically one more time. So 2 traders can trade this setup, R to R of 1 to 1. Same winning percentage all across here. Whatever winning percentage they have, individually, all different, of course, for the different setups. Let's say this is 52%. Just assume. Trader A could be making money, but Trader B could be losing money. Same setup, same everything, except the allocation of risk is slightly different. And Trader B is losing now. Same here for 2 to 1. Same for 3 to 1. Same for 4 to 1. Same for 5, and so on, etc., and so on. It applies to all setups based on reward to risk ratio. So two traders can be trading this, one making a profit, the other having a loss. The only difference is the allocation of risk. That's all. Even a slight difference can make a world of difference. You see that? So how do we go about doing this? So I'm going to go to my spreadsheet now, but before I do that, I just want to present to those of you who are a little bit rusty on your mathematics, just simple, just one page, very simple, super simple. I just want to recap and refresh your memory, okay? Quickly, in just a few lines of equations, just to refresh your memory so you understand the spreadsheet. Otherwise, if you are too rusty and it was like 1,000 years ago since you've been to high school or college, then okay, this is the slide for you going forward. Especially for you guys that are super rusty in your mathematics. But in fact, it's so simple. It's simple stuff, okay? But I just want to make it self-contained so you don't have to go refer to other books and try to understand what I'm saying. I'll try to keep all self-contained. Okay, let's go. So let's do a quick refresher, very quick. Okay? All right, this is to do your initial capital. Let's say you have initial capital of $100 in your account. I mean, this is just an example, of course. And these are the way you experience gains and losses based on the ratio that you use. So, for example, let's say you do not want to make any money. Neither do you want to lose any money. So, your initial $100 that you have in your trading account, just multiply by that by 1. And you get a break-even outcome. That means you don't make, you don't lose. So this is not a winning trade. This is not a losing trade. This is a break-even trade. Okay? How about this one here? Now, let's say you want to make 10%. So you put your take profit at a point based on your lot size that if your take profit is taken out, you make 10%. Let's assume that's the case. So to make 10%, you just need to multiply 100, your initial capital, by 1.1. This represents 10%. So you get 110. $10 more than your initial capital of 100. So you make 10%. Simple, right? Isn't it straightforward? Am I reviving your old memory cells at this point? Yeah, or you might feel a sense of dread. Okay, I don't know. Now, so this represents a winning trade. You make 10%. What about this? This represents a losing trade. Anything 1 is break even. Anything above 1 represents a winning trade. Anything below 1, like this one, represents a losing trade. So here you will lose 10%. This is 100%. This is making 10%. This is losing 10%. So if you want to lose 10%, just multiply your initial capital of 100 and you get 90. That represents a loss of 10%. So this is a break-even trade. This represents a winning trade, and this represents a losing trade. So let's assume we have this simple scenario. Let's say you have an initial capital of 100 US dollars, okay? Or whatever currency, I don't know. And you experience the first trade was a winning trade, you make 10%, and the second trade was a losing trade, and you lost 10%. So what is the outcome? If you do the mathematics, it's quite simple. You end up with a loss. Overall, you lose 1% of your capital. You see that? So just because you have one winning trade, which you make 10%, followed by one losing trade, which you lost 10%, a lot of traders think that they go back to break even. Well, that's not true. You don't go back to break even. One winning trade followed by one equal losing trade are 1-to-1. Reward is 10, the loss is 10. Reward to risk ratio is still 1-to-1. You make 10. You lose 10. It's 1-to-1. Reward is 10, risk is 10. You still lose money. Why is that? Because many of you I'm sure you understand this if you're a mathematician or physicist or even normal person that done doing a lot of business and accounting for your company. You understand all this. It's quite straightforward because because this represents a geometric expectancy outcome, based on a non-linear outcome. Well, say each time you win $10. Each time you lose $10. Yes, one win, one loss brings you back to your original capital. But then we don't use the multiplication sign. We use the plus and minus sign. It's different. When you use multiplication, it's non-linear. Different. I call it geometric expectancy. That means your geometric average profit and loss, not your linear. But the problem is this: when you go to a lot of YouTube videos or even seminars or read certain books, sometimes the message is not clear. They say, okay, if you have 5 losing trades, you lose $5. If you followed by 5 consecutive winning trades, you make $5. Assuming it's a 1-to-1. So you lose 5 in the first 5 trades, you win 5 in the next 5 trades, you go back to break even. Neither did you make money, nor did you lose any money. Yes, that is true. But when you start trading and you're risking a percentage of your capital, now there's a significant, horrendous disconnect. In your mind, you're thinking linear expectancy, but when you trade, you're adopting geometric expectancy. And now you have a big problem. That's where the disconnect is. That's where the discrepancy lies. Okay? But nevertheless, that is not the main issue either. That is just a matter of confusion, which can be resolved very easily. Like right now, I'm trying to help you understand that. Okay? But this is not the problem. The problem is this. This. How did this happen between setup 2 and 3? Yeah, 1 and 2 we understand, but between 2 and 3, why did this happen? Why? What's all that then? But the clue is this, the hint is this. It's something to do with this. Okay? I cannot go into the mathematics of it. It's beyond the scope of this YouTube video, but I'll show you the spreadsheet, okay? The one I created a few years ago. So right now, let's pop over to the spreadsheet, okay? And let me try to elaborate just a little bit more. Okay, let's go. Okay, well, now we have pressed on to the next slide. This is my Excel spreadsheet. I created this many years ago. So let's look at the effects of risk size. I mean, the allocation of risk. The stuff that I talked about over the last few minutes. Let's see how that affects our profitability. Okay, let's go. Scenario A. Let's assume we have 5 wins and 5 losses. So therefore, our winning percentage is 50%. So far, so good, okay? I'm sure everyone can say. If you have 5 wins and followed by 5 losses or whatever, the sequence doesn't matter. It doesn't have to be consecutive. It can be random all over within the space or window of 10 trades. It's 50%. Your win percent. Alternately, we can also say that our losing percent is also 50%. But I choose to use the winning percentage, okay? Because that's what we want to refer to, okay, going forward. Okay? So let's assume this is the case. Now, let's assume that we have a reward to risk ratio set up, just like what we saw here. Okay, we have something like that, a 1-to-1. Okay, let's assume a 1-to-1. Okay, let's go back to the spreadsheet. Okay, a 1-to-1. So let's assume we have a reward ratio of 1-to-1. Okay, so when we win, when we make money, when we exit at our take profit, we make 1%. 1.01 is 1%. Remember, I talked about this over here. 1.1 is 10%. So 1% is 1.01. Okay, for those of you who are like really rusty. Okay, so rusty you might need a tetanus shot. So let's go. Sorry. Okay, sometimes I'm a little bit, So let's go back. So again, just to refresh your memory, I just want to make it as self-contained as possible, so you don't have to go figure out what this all means. Okay, so here this is our profit ratio. That means our reward. Okay, so when we make money, we want to make. If we exit our take profit, we want to make 1%. Similarly, if we lose, we want to lose 1%. So this represents our reward. So far, okay, right? This represents our risk. A win of 1%. If you lose 1%. So that's all. Therefore, what I'm saying is that we are risking 1% to make 1%. Okay, it's a 1-to-1. As you can see here, 1-to-1. Our reward ratio is 1-to-1. Okay. Now, because if we experience 5 wins followed by 5 losses, and this is geometric, it's not linear. Then we go back to this problem again. This one 1 win, 1 loss, we still lose. We need a much higher win or much lower loss in order to make this equals to 1, that means break even, or higher, in order to make a profit. This will not work. For a geometric adoption in terms of money measure, adoption of a geometric approach in terms of money measure, this will not go back to break even. It will not give you that. Mathematically, it's impossible. Not to mention the cost of trading, the negative swap, all that makes it even worse. Okay, so let's go back to the spreadsheet. Okay, so as you know, 5 win, 5 losses, you will lose money. You will lose money. Is this 1? It's not. 1 is break even. This is below 1. You are losing money right now. Is that surprising? No, it's not surprising. If you understood what I said earlier in the previous slide, this is not surprising. You could have guessed that already. 5 win, 5 losses. 1 win, 1 loss. 10 wins, 10 losses. You will not come back to break even. You will get close to break even, but you won't be at break even. It's not possible, mathematically speaking. So therefore, in reality, it will not happen as well, because when you add on the trading costs, things will get much worse. Very, very fast. Things will go sideways so fast, you won't even know what hit you. So therefore, what we really need is 5.05 wins in order to break even. But I know it's not possible because this is just mathematical. So we need to win. Our winning percentage must be at least 50.25%, not 50. 50 is not good enough, because if it's 50, you still lose money. This is below 1. Below 1 means it's negative negative expectancy. Above 1 is positive. That means you're making money. So losing money. Okay. Now, if you're losing money and you do more trades, you're going to lose even more money, because every trade every set of 1 win and 1 loss gives you a loss. So if you have 500 wins followed by 500 consecutive, let's make it doesn't have to be consecutive, but if you have 500 wins and 500 losses within that 1,000 trades that you did, of course the winning percentage is still 50%, but you're going to lose even more. Here you only lost a little bit, 0.0005% of your capital. Here you have lost much more. You only have 95% left. Here you had 99.95. So 99.95. Here you only have 95.2% left. And if you continue trading even more trades, you're going to compound the losses tremendously, significantly. So now you only have 60% of your capital left. you lost about 40%. So if it's a losing system, don't trade, don't execute more trades. If your expectancy is negative, don't trade more trades. Don't execute more trades in the market. The more you trade, the more positions you open, assuming everything else being equal, you're going to lose more money. It's a losing proposition, as they say. Graphically, what does this look like? This one. Well, graphically, it looks like this. See, look at this, 0.9995. That means 99.95%. That's all you have. I mean, you've lost a little bit. The more you trade, the more you lose, because it's already a losing system based on the adoption of the geometric money management approach. So therefore, from this graph, you see, okay, this 0.01 means 1%. If you reach 1%, which is here, 1%. If you make 1%. If you lose 1%. If you reach 1%, you're already losing. You're already experiencing negative expectancy. Not 1. If this is 1, it's still break even. Above 1, congratulations, you make money. So if you reach 1%, here, you already, I know you can't see, but if you zoom in, you can see this is below 1. It's 0.9995, just below 1. 1 is break even. So even with 1%, you're not even break even. If you reach 2%, if you reach 3%, 4%, 5%, more than 1%, you're going to lose money very fast. So here, if you reach 6%, immediately you can see, after 5 trades, after 10 trades, 5 winning trades and 5 losing trades, you lose money. In fact, anything above 1, you lose very quickly, very fast, almost in an exponential manner. I only went up to 50%. I mean, nobody reached 50% per trade. I mean, this is ridiculous. But you can see, this is already a losing system. So the more you risk, the worse it gets. For example, let's see, this is 0.02, means 2%. That means if this is 1.02, if you make 2%, if you lose, it's 0.98. If you lose 2% as well. And then you'll be here somewhere. 2 is here. You'll be somewhere way below 1. You'll be losing much more than if you reach 1%. You see that? This is the non-linear effect of risking in percentages. You must understand it. Now, this is okay. Okay, so the more you trade a losing system, the more you lose. Okay, so far it makes sense. Nothing counterintuitive or non-intuitive about this. Let's go to the next one, the next sheet. Let's see what happens now. I'm going to present you something different. Have a look at this. Okay, this is a second example. Let's say we have 7 wins. Okay, just randomly, let's say we have 7 wins, followed by 6 losses. So what is our win percentage? Of course, we have more wins than losses. So our win percentage, if you do the mathematics, is 53.85%. Okay? So far everything's so good. This makes sense. I mean, anyone can do this mathematics, even a high school kid or not. They can do all this. It's simple. Okay? So it's 7 divided by 7 plus 6 and all that. So multiply by 100%, you get this. Now, let's assume this is also a 1-to-1 reward ratio setup. All of these are 1-to-1. So here, we reach 1%. We risk 1% to make 1%. We risk 1% to make 1%. Same here. Let's look at this scenario A first. So we reach 1% and make 1%. Okay. Now, is this a winning system? Answer is yes. It's above 1. That means, on average, we make money. It's a winning system. Now, if it's a winning system, if we increase our reward to risk ratio, instead of 1-to-1, let's still keep it 1-to-1, but we increase the percentage. So here, if we win 3%, but we risk 3% to make 3%. It's still 1-to-1. Am I right? 1-to-1. 1-to-1. All these are 1-to-1. It's not that this is 1-to-1, this is 2-to-1. No. I want to show you everything else being equal. This is 1-to-1, but the risk that you allocate is 1%. 1% risk to make 1%. Here, you risk 3% to make 3%. It's still 1-to-1, It's still 1-to-1. Okay. So since this is a winning system, remember in our PowerPoint that we covered here, if this is positive, making money, let's assume 0.1. If we increase the percentage, we make more money. So far, so good, right? So let's have a look. Let's go back to our spreadsheet. Sorry, here. Okay. So here is a winning system. We make money. So let's increase, instead of 1% to make 1%, let's increase it to 3% to make 3%. You see, this is above 1, this is way above 1. Here we make 1 point something percent. Here we make we make 2% on our capital. 1.02 is 2%. We make 2.45%. Here we make just under 1%. Here we make more money. It is more profitable. It makes sense, right? Based on our PowerPoint illustration. Since it's a winning system, it's above 1. You risk more, you make more. Much more. More than scenario B, more than scenario A. And since it's a winning system, why not let's still 1-to-1, but let's increase it. We risk 5% to make 5%. And we make even more money. We are even more profitable. Makes sense. Logical. Rational. Understandable. Comprehensible. Totally intuitive. Totally visceral. Totally makes sense. So far, so good, right? Yeah, but that's only half the picture. All of these are still 1-to-1, but that's only half the picture. Let's show you the other half. Look at the chart here. If you map it out, 3.92%. If you reach 3.92% over here, this is this is 3%. Okay, this is 5%, and you still make money. Okay, let's have a look. 1%, 2%, 3%, 4%, 5%. So as you risk more and more, you see, we make more money. You see, it gets higher above 1, higher above 1, higher above 1, up to 5, higher above 1. You reach 6%, higher above 1. You reach 7%, even more money you make. You reach 8%, you make even more. Here, 8% is at the peak here. But if you go beyond 8%, you're still making money, but you're starting to lose. You see 1 point something, 1.7, but it's getting lower. And at this point here, if you reach 16%, you start losing money. Somewhere here. Break even is around, let's see, between 15 and 16. Okay, somewhere between 15 and 16% is break even here. Come down, it's about here, 15, 16. Below, anything more than 16% here, or 16 and higher, you start losing money. Nothing has changed. Your winning percentage is still the same. Everything is the same. Nothing has changed. Nothing. Still 53% and all that. Although you only need 50% to win, but you are even better. You're 53. That's why you're making money. And as we increase our risk, we make more money. Makes sense. But the thing is this, more than that, you go beyond 16 and beyond, you start losing money. Nothing has changed. Has your percentage wins lost? Has your percentage winning declined? Did it fall? No, it's the same. 50.25 is the mean, but you're making 53 all the way, 53 all the way, 53 all the way. And it's all making money. Once you hit more than 16% or more, you start losing money. Can you see? This is how non-linearity, the non-linear aspect comes in. Just because your system is a winning system, the more you risk, the more you make. That is not true. There is a cutoff. This is the cutoff here. Beyond that, it's bye-bye. You're being sucked into a black hole, a slippery slope that you cannot get out of. Okay, but again, in reality, nobody risks 16% per trade. But I'm saying, if you ask, is there a way, can we experience here, this part? Okay, we don't want to go below this 8%, because below 8% means from this point, although as you fall, you're still making money, but you're not making as much. And you're starting, once you fall below 1, you start losing money. Okay, but 8% is still very high. 8% per trade is still too high. How do we incorporate this into our trading and still get 8% but by not risking it in one trade? Now, that is a story for another day. But this is the optimum. But this is not the point. The point is that although it's still a winning system, nothing has changed. You start losing money. If you watch your equity, you see your equity fall. Then the first thing you go back and check is, are you winning at the same percentage? Yeah. Your platform, the account history shows that you're still winning at 53.85. Nothing has changed. You just put a little bit more risk in. That's all. You see that? So once you pass 16, you start losing. How many people know this? The logical thing to do is that if you have a winning system, the more you put, the more you win. So far, here we are fooled. We are fooled by the system. More money, so we risk more, we make more. We risk more, we make more. And therefore, we assume that going forward, the more you risk, the more you make. Wrong. There is a cutoff point. Let me show you another example. Hang on. Let me go to the next slide. Let me show you another example. Okay, this is a third scenario. Obviously the third example. So scenario A, let's assume we have 50 winning trades and 49 losing trades. Okay, altogether 99 trades. Okay, all right. And our winning percentage, if you just do the calculation, our minimum win is 50. Oh no, sorry. Our winning percentage in this case is 50. Sorry, it's 50. But again, let's do a 1-to-1. Okay, let's do a 1-to-1. We risk 1% to make 1%. So the reward to risk ratio is 1-to-1. Is this a profitable system? Assuming we ignore all the trading costs and all that. Answer yes. Is this above 1? Yes, it's above break even. We are making money. We are making money. Fantastic. 1-to-1. Risk 1 to make 1%, we make money. Makes sense, right? If you go back to our earlier example, here, sorry, this one, we make money for 1%, we're risking 1 to make 1. Here we risk 3 to make, we make more money. Here we risk 5 to make, we will make even more money. But then we come to this example, we have 50 winning trades and 49 losing trades. Risk 1-to-1, 1% for 1%. We have a winning system. It's above 1. Not a lot above 1, but still is a winning system. So same thing should apply, right? We increase from 1, risking 1 to make 1. We risk 3 to make 3, all still 1-to-1. What is going on here? Now we're supposed to be following the earlier example. If it's a winning system, if you risk more, we should make more. But no. What's going on? We risk a bit more, we should make more, but we are making less. Under this, a value of below 1, we are losing money. And we continue to trade. Again, we risk 5% to make 5, we lose even more. What? This is complete opposite. Sorry. Opposite to this. Here we are making money, same as what I showed. We risk more, we make more. We risk a little bit more, we make even more. But in this case, it's different. We make money, we risk a little bit more, we start losing. We risk a little bit more, we lose even more. What is going on? Honestly, really? Can a normal trader understand all this or not? You tell me. Do they even look at this kind of problems? They just worry about where the trend lines are, what moving average look back period is the best after back testing, where to enter, where to exit. But all this eludes them. This is only issue number 5. We have not even reached 10 yet. Shock factor issue beyond 5. This is only up to 5. And we have 5 massive problems to resolve over the last 5 videos, including this, of course. Do you really dare to put your money in the market without knowing where the cutoff is, where the threshold is? Really? Come on. It's a losing proposition. As I said, don't do it until you know how to solve it. Okay? If you don't know how to swim, okay, is it wise to jump into a pool 10 foot deep and start swimming? Nobody does that except traders. Traders do that. They jump into a pool without knowing how to swim. I see it all the time because they have the best case scenario mindset. That is the problem. Okay, another thing is that practice makes perfect as well. You can read all the books on swimming if you like, or all the books on swimming. You buy 10 best books on the planet about learning how to swim. And you read and you read it over and over. You read each book 5 or 6 times. You make notes and you memorize everything. And then the next minute you jump into a pool. Guess what? You're going to drown. 99% you're going to drown. You understand everything about it. Inside all the nuances, all the little details, the nuts and bolts, the little nitty gritty stuff. But once you jump into the pool, after reading 50 books, you will drown. Most likely. Okay? Why is that? That is a different question altogether. That is an executional question. See, sometimes we understand, but if you have not traded life, you won't understand the life execution issues. And all this also contributes to all that problems. All this contributes to all the challenges that you have. As if we cannot make things any worse than this. And let me promise you, it will get worse going forward. Okay? I promise you that. It's going to get worse. So, in this scenario, unlike the previous one here, winning, risk more, win more. Risk more, gain even more. Now, same thing exactly. Winning, risk more, lose. Risk more, lose even more. I mean, what are you going to do? Do you dare to get into the market and participate with real money? Really? And when this happens, there's no way you can change the angle of your trend line. You can change the look back period of your moving average. You can look only for the third phase of the Elliott wave and forget all only the impulsive part. Forget all the other parts. You can filter, modify, whatever conditions you want to filter out or impose on yourself in terms of the technical approach. You're still not going to solve this problem. No amount of technical analysis, no amount of psychology, no amount of NLP will solve any of this problem. You got to know the numbers. You got to know the numbers. Where is the threshold if you're applying a percentage per trade? You're going to have this issue. Okay? This makes shock factor video 1 even worse for trader A. In the first example, where the trader A uses percent risk per trade. Trader B uses fixed lot. Is different. This makes traders A problem even worse. That trader B don't experience. Trader B don't have this problem, but trader A has. So in this case, the chart looks like this, or the graph. Okay, if you risk 1%, look at 1%. Anything 1%, you make money. This is above 1. If you risk 2%, you still make money. If you risk 3%, it's gone. It's bye-bye. Okay, see, 3%, we risk 3% to make 3. Losing, you're losing. So if you risk 3%, you're losing. You risk 1 or 2%, you're still making money. Once you hit 3, game over. You're on the way down. You're on that slippery slope, sliding down all the way to the bottom. And that's the end of it. Okay? Now, you don't have to increase your risk. Just stay at 3%. Just stay there. Just trade at 3%. Here. Just trade 3%. Just trade this. The more trades you do, as you saw, right? If you have a losing system, let's go back to 1. If you have a losing system, the more you trade, the more you lose. Okay, so coming back to this, you have a losing system. The more you trade, the more you're going to lose. If you go at 3%, 3% is losing. If you trade more, 59, 49, you increase the number of trades, you're going to lose even more. Assuming your win percentage stays constant. But if you increase this to 500 to 490, it's going to be bye-bye. You lose even more and more and more. Okay? Forget about increasing the percent risk. Just increasing the numbers from this point onwards, from B onwards, C, D, whatever, it's all going to be below break even. You're going to lose money. Can you see that? Just a matter of 1 or 2% difference, you start losing. Actually, let me show you one more example. I have two more actually. Let's go. It's so exciting. Let's press forward. Okay. In the name of trying to save ourselves. Okay. Okay, this is another scenario. I just want to share. This is the last one. Okay, one more. So let's assume we have a scenario, and this is a trade setup. Now this is different. This is a 2-to-1. You risk 1% to make 2%. You risk 1% to make 2%. Okay, so it's a 2-to-1. The rest that we were looking at earlier, they were all 1-to-1. So this is a 2-to-1. Okay. Because as I mentioned here in the PowerPoint, it doesn't matter what ratio setup you use. This applies across all reward risk ratio setups, all of it. So let's get back to the Excel spreadsheet. Let's have a look what's going on here. So here, let's assume we have this kind of wins and losses, and your winning percentage is 34. But you know what? Because each time you make 2%, each time you lose, you only lose 1%. Overall, you make money. You make money. So this is a winning system. Guess what? If you have a winning system, the more trades you do, you should make more, right? But in this case, I'm not going to test that. I'm going to test something else. If you risk 2%, if you risk 1% to make 2%, it's a 2-to-1. And assuming that gives you a profitable system. Good. Okay. Let's do a 2-to-1 here. Here we risk 2% to make 4%. It's a 2-to-1, right? You risk 2 to make 4. 4 over 2, divide 4 by 2, you get to a reward ratio of 2. So again, it's a winning system. Since this is a winning system, and remember, if we increase our risk, we could possibly make more money. Yes, and we make more money. Since we are confident that this is a winning system, just like the first one, sorry, let's increase the risk a little bit more. Let's risk 5% to make 10%. It's still a 2-to-1. You risk 5 to make 10. 10 divided by 5 is 2. Now you have a losing system. You risk 2-to-1. In this scenario, you make money. Still 2-to-1, but you increase the percent risk. You still make more money. In fact, you make more money. Increase still 2-to-1, but 5% to make 10. Now you're losing money. Can you see that? Can technical analysis help you resolve this? Can changing the angle of your trend line solve this? Can changing your look back period solve this? Can picking select parts of the Elliott wave solve this? Can changing the settings for Ichimoku help you solve this? Can changing the settings of the stochastic oscillator help you solve this? That goes for the RSI, that goes for the MACD, that goes for every indicator oscillator, whether it's an overlay or window indicator. Doesn't matter. None of that can solve these problems. It lies outside the realm of technical analysis, outside the realm of psychology, outside the realm of NLP. Although those are all good things, but you cannot solve this problem. They are not the right tools to engage in, to solve this kind of problems that I'm going to present to you from video 1 to 15. None of that can help you. None. Although they are good, you should pursue them. But it can't help you in solving these issues. There's most traders don't know how to solve anything. Forget about solving. They don't even know they have a problem. They don't know what they're completely unaware of. They don't know what they don't know. You see that? So in this case, the graph looks like this. Again, look at this. When we risk 2%, risk 2% to make 4%. Okay, 2% means 2% here. We're still above 1. You're still making money. 1%, you make a little bit of money. 2%, you make more money. 3%, you're starting to make less money. Not losing money, but making less. 4%, you almost at break even. Anything above 5%, you start losing. This is below 1. 0.96 is 96.53%. Anything 5 and above, you start losing money. So you're making money. You risk a bit more, you make a bit more. You risk a bit more, you make a bit more. You risk a bit more, you make a bit more. You risk a bit more, and you make a bit more. You risk a bit more, you're making but a bit less, but still making. You risk a bit more, yeah, you're still making but a bit less. You risk a bit more, don't seem to make any difference. You're going back to break even. You risk a bit more, you start losing money. You see that? Anything, let's see here. Anything above 4%, you start losing money. But how can we determine all this? If you're using a percent of your capital, a percent of your current capital, not a percent of your initial capital, that's a different thing. That's linear. Using a percent of your current capital, that's geometric. That's where this problem begins. You see that? So, okay, anyway, I don't take up your time too long. I don't detain you any further. I know life is full of challenges. You got other things to do, but I behoove you, and I implore you, if you want to be a professional trader and trade for the longest time and make money throughout your life, you have to solve all these issues. If not, I recommend do something else. No point getting into the market with just some simple knowledge about Elliott wave, some simple knowledge about some indicator. Forget all about it. Trust me. I'm trying to save you here, okay? To the best that, remember, I have a passion for this. I really, it's better you don't make any money than lose money. Better you don't make any money as compared to losing money. It's better, okay? It's better. Because when you lose and you don't know why you lose, that is the biggest problem. If you knew exactly why you lost, it's fantastic. Now you can solve it. You can solve it all. But how do we know? It's so complex. It's a complex issue, You're dealing with something very difficult. No one wants you to, I'm just saying, no one wants to tell you the bad news, but I'm telling you the bad news. But is there a light at the end of the tunnel? Yes, there is. But before that, we need to understand, what are we facing? What are the invisible forces that will obliterate our account without us even knowing what that force is? Do you want to be in that position? I don't want you to be depressed too much, but the next video is going up very shortly, okay? And again, I'll present another issue. All right, take care. Thank you so much for joining me in this video. Hopefully, I've enlightened you a little bit. I'm not trying to depress anybody, but I'm trying to give you hope. But I'm trying to give you hope going forward. Unless you know what the problem is, do not venture into darkness without having a way of seeing your way going forward, without having a way of understanding what are the challenges that is in front of you, that's confronting you, without you, which for the most part you can't even see it coming. You can't even see it for most traders, I'm saying. All right, thank you. Anyway, thank you so much for joining me in this video. Again, as I'll show you in the next video. But until then, as usual, take care, be safe, and bye-bye.